Audio Jungle. The first time it occurred was at the very beginning of capitalism, the mid-17th century. In 1634 Holland, because of a rare plant virus, there were tulip bulbs that grew into a psychedelically colorful tulip flower. These mutant flowers were very unusual and hard to raise, so they became a hot commodity in the marketplace. By 1637, dealers looking to buy the rare bulbs greatly outnumbered sellers. Driven by demand plus the expectation of big profits, the price for these flower bulbs rose crazily. And for a little while, the flower bulbs cost even more than gold. Then, when the buyers had bags and bags full of these overpriced tulips, they went to cash them in, sell them. Nobody wanted to pay those high prices anymore because they had bags full of their own high-priced bulbs. The prices started to drop in an even crazier selling panic. The highly inflated price of the rare tulips wilted. There have been plenty of bubbles in the past. In the 1700s, a British company sold shares in Spain's South American colonies. Speculation drove the stocks up wildly on the London Exchange. And then they collapsed because they were essentially worthless. In the 20s, half the population of Miami became real estate agents. In 1 year, properties doubled in price with no relation to the actual value of the land. A year later, there was a vast amount of land for sale and no buyers. The bottom fell out. Later in that decade, industrial stocks followed the same foolish pattern. Greed and speculation drove stock prices sky high on relatively worthless equities, causing the infamous stock market crash of 1929. Mergers and acquisitions in the 80s fooled investors into highly overvaluing the newly conglomerated companies. Then those companies predictably failed to perform. The stocks plummeted. Then dot-com innovative technologies in 2000 caused the same baseless overvaluing of initial stock offerings for companies with no earnings records. No profits. Again, disaster. As recently as 2005, subprime mortgages repackaged as low-risk bonds led the market down the same well-worn path in 2007 and 2008. We're still feeling the effects of that foolish and unbridled speculation. All of these are examples of the notorious bubble pattern. Assets in a certain category rise wildly without good reason, then fall even more widely, leaving those investors who miscalculate stuck with heavy losses or bankrupt. So any investors whose crystal ball turns out to be completely accurate and correctly predicts the right moment to buy and then sell before the market turns around, he or she can make a lot of money when a bubble happens. Unfortunately, they who profit from bubbles are few and far between. Historically, the crystal balls are often wrong. Most investments that make money make small profits, but reliably. They trade at prices close to what the stocks are really worth, looking at the assets and profits of the companies they represent.